As 2024 comes to an end, it is very important to assimilate the learnings of 2024, see where things did not happen the way we expected, opportunities where we didn't make money, and start 2025 with a fresh perspective. The performance in stock markets is typically benchmarked against Nifty, and Nifty has gone up for the year, no doubt about it. However, I wanted to draw your attention to one important point. This is January 2024. If you see this particular portion ending at the result of general elections, this is the 4th of June spike or rather fall, Nifty did not go anywhere in this period. In fact, most period Nifty was above this particular line. What that means is people who are investing money in this period anticipating good results in the elections, they didn't make money in this particular 6-month period. After this spike, while Nifty went up and there was general euphoria, Nifty made new highs. If you again draw a line here leading to today, Nifty has been above this line all the time, and this is where we are today. That again means that people who have put in fresh money via SIPs, via equity direct, they have not made any money in this particular period. People who invested long term, last 4 years, 5 years, 2 years, they would definitely have made money. That is where long term SIPs make more sense. And this period has been marred with lot of commotion. Wars have been happening all around us. The taxes on investments, LTCG, STCG, they have changed. We'll now have the third budget in a space of 12 months. And while there is no official data saying this, I feel at least in the last quarter or so, the jobless count has gone up in terms of percentages also, leading to fall in consumption. Inflation in any case has been high only. There are two things which are happening: unprecedented policy changes, and the RBI governor and the finance minister never signed up for a popularity contest in any case. They are doing their job to take the economy ahead in full steam. Also, the climate change globally has not been kind at all. Yesterday only I was talking about the impact on coffee, cocoa. The prices are at an all-time high. 3 years Africa crops have been sulking. Africa accounts for nearly 75% of the global production. With this background, I'll take you through 12 of my learnings. This will be fast-paced. If something is not clear, leave a comment and I'll recover that topic in the nuggets in the coming weeks. The first one is making money from special events. This is very close to me for the simple reason I have recently lost a lot of money because of this. The first one is MSCI rebalancing. Morgan Stanley rebalances its India index 4 times a year. Published dates, list of stocks is known which will come out or go in. Yet it becomes very hard, though we know that billions of dollars will flow in or flow out from a specific stock. This becomes even a bigger problem for the FNO listed stocks. Similar is the case for the stocks which are impacted during Nifty 50, Next 50 rejigs. We know that the mutual funds, ETFs, which are holding those stocks or which are not holding those stocks, they will have to rebalance. Millions and billions will come in or flow out. I usually have ended up on the wrong side only. IPOs have become a trader's paradise. Companies trying to raise 10 crores, they are getting thousands of crores worth of applications. People want to make money and exit on day 1 or day 2 max. People holding beyond a week probably are making losses in the IPO. The corporate events like bonus, rights issues, splits, dividends, they were very predictable about a year or 2 years back. On dividend day, the stock would fall. Bonus and splits typically meant that the liquidity will go up. There will be more trading happening in otherwise expensive stocks. This is no longer the case. After bonus, splits, rights issues, when the number of stocks increases, the stocks are going down, tanking at times. Even result-wise, good result days, companies are being punished, they are falling. That is because anticipation was that the result will be even better. And companies with not so good results, their stock is going up because the expectation was very low. You could try going the other way, that also is not profitable. The second one, this is a bit controversial, many people will not agree. FNO is not for investors and small traders. And I have learned this by losing lakhs of rupees. Note that traders who are dedicated for FNO, even if they are playing at a small scale, I am not talking about them. They are professionals. They are not people who are working for a salary otherwise and buying some call options, put options in the background to just try and make a little money. That is pure gambling. And believe me, most people play futures as well as options without any hedge, without any downward protection. This is gambling. This is not trading. If you don't have a percentage profit in your mind when you take a trade at which you will exit, be it in a loss or be it in profit, you are not trading. Traders have a characteristic called discipline. They have experience. They know what the graph means. Please note that you are trading against very high grade algorithms, people with lot of money, and they are creating huge swings in the market. I told you last week, Nifty on a specific day traversed 5% in a single day in ups and downs. Option selling is also not safe these days. The third one, you can take it in a humor, markets understanding. You will probably make money in the market till you don't understand the market. The day you feel that you have understood the market, you will make money 1 or 2 times, and then you will get into severe overconfidence. Your trading volumes will go up, your trading amount per trade that will go up, and that is where you will lose money big time. I'm talking about trading, not investment here. Patterns repeat at macro level. This is what happens with experience. You understand the patterns, but patterns don't repeat exactly at micro levels. For example, if China is having a stimulus right now, or if China's economy is improving, what will that lead to? Will steel prices go up now necessarily? Will soda ash prices go down, which crashed when China was sulking? Every time we go wrong, we will find one new reason because of which the theory went wrong. Next time we'll find the second one, next time we'll find the third one, and then we will deal with the permutations of them. I am guilty of this fourth one for months and years. I've done it most of my life. Don't trade ahead of markets. This specially happens to people who can foresee events ahead of time. For example, what will happen around budget this time? They create a hypothesis, they play to it, but they don't get the timing right. Please note that the market participants, most of them don't spend time on what they don't know. They don't try to understand, for example, balance sheets, P&L statements, how the industry is doing, the macro graphs for commodities and so on. What typically happens in my case is I buy ahead of time, which makes me buy high and also blocks my capital severely. Look at MRPL for example. I am, after today's rally of 4.5-5%, still at a loss of around 17-18%. And I've been holding that stock for 6 months waiting for a rally because I thought that the crude prices going down will be beneficial for MRPL, which deals with ATF and high speed diesel. Did not happen because people put all oil stocks in the same category. Also, too long waiting often leads to loss in conviction, making you tap out early. Happened to me in Kefin Technologies recently. I was holding a very large quantity for a month, it did not move. And as soon as I sold it, it has gone up nearly 30-35%. I've lost several lakhs virtually in that particular case because my conviction was there, but I ran out of patience. Many people will not agree with this particular point. Buy in bulk, but sell in tranches. Lot of people buy in tranches also. What that means is they'll buy say 25% in first day. If the stock falls, they will buy another 25% and so on. For patient investors, this may work, but only if the stock moves as you want, or if you are happy to just let go of the trade if it does not play out the way you wanted. These days, stocks which are supposed to go up, they go up 20-30% in 1 or 2 days itself. Many times you will see a stock has run up 50% while you are waiting for it to correct a bit and give you an opening to buy. After that, it is not possible to put your money and buy when the stock run up has already happened. Better is to buy say minimum quantity, ideally in units, so 1 unit or 2 units at a time, with an option to average lower if the stock falls a lot. When it comes to selling, however, don't sell probably in one go. Think of any ratio which works for you: 25-50, 25, 33, 33, 33, 50, 50. Because when you are selling, typically stock is already going up. You typically don't sell when the stock is going down. On the up move, if you sell here, like I sold Kefin, it may go up a lot next day, next week, and so on. Create some sort of algo for yourself in your mind and sell in tranches. If you say sell 25% and the stock immediately retreats, maybe the stock is good, you can buy it back. Don't mess with global influence. There's a lot happening globally. The biggest one right now is China. China is trying to come out of a slumber, and a lot is happening in the commodity market specifically. But think of Indian companies that are getting impacted. For example, Tata's Jaguar and Land Rover. The big markets are UK and China. Both of them are sulking. This is impacting Tata results severely, Tata Motors. Similarly, steel wise, a lot of dumping happens from China. That impacts Tata Steel a lot. Soda ash, companies like Tata Chemicals, DCW. If China demand goes down, then the demand for glass goes down. Demand for soda ash goes down drastically in those cases. And I have a video on my channel where I lost a lot of money because I tried to trade into soda ash. There are multiple wars going on. People have tried to make money by shorting or going long on certain commodities. For example, when the Ukraine-Russia war broke out, the energy prices went through the roof. The oil prices are thankfully down right now. Usually in these kind of ecosystems, oil prices go north above $120, $130 at times. In fact, OPEC has given a tepid kind of forecast for 2025. Otherwise, all hell would have broken loose on us as of now. Japan's yen and the yen carry trades has been driving investors crazy for decades now. The dollar is strengthening. Donald Trump will be back as president on 20th January. It is hard to align your investments with these global events. Differentiate between trade and investment, and trade comes with a stop loss. You can't convert a trade into an investment if it goes wrong. Understand the cycles, and here let me give a disclaimer first. While cycles repeat, cycles don't repeat exactly the same way. For example, sugar has a cycle. When the weather is favorable for sugar, when the crude prices are favorable, then sugar does well because there is a ethanol story. Now sugar typically needs policy and crude prices to be high. India is saying that we will make mandatory blending of ethanol in the crude or in the finished products so that our import bill goes down. That is taking sugar stocks up to a large extent. Now sugar also has a quarterly cycle. The harvest happens in Q4. Microfinance is going through a bad cycle right now. It's a 4 to 5 year cycle. I got caught in the wrong side. I have severe amount of losses and money blocked into it right now. I didn't understand completely the downward part of it because of elections. I understand it now after paying a hefty price. Banking, we have seen public sector banks down in the dumps. Then they skyrocketed. Then they are again coming down. Private banks are down even more. Banking has a cycle. Can't invest long term 8-10 years in cyclical stocks and sectors because they will go up and they will come down. You will make virtual money and that money will be lost or even give you losses, virtual ones or real ones. There are times when governments have to protect local economy. If globally the crude prices go up, then there is a windfall tax added on exports of finished crude products. Similarly, if steel is going up globally, then we put an export duty on steel so that there is no big incentive to export steel because that will lead to shortages in the country. It is not just India, all governments globally do it. Malaysia, Thailand, for example, put these duties on palm oil when palm oil is in shortage. That led to severe palm oil shortage about a year or 2 years back. Typical commodities that India exports, these are some examples: sugar, steel, soda ash, tea, coffee. All these get impacted when globally demand is high, supply is low, and government adds certain duties. So what typically happens is when it is time to make money in the global markets, the policy action kills that particular move and you don't make money. In fact, the prices of the stocks may crash in the domestic market because of the restrictions. But when the cycle is bad, then there is no such sop given to these industries. So that is where they sulk yet again. This is a harsh one and this is maybe a subjective opinion from me. There are certain sectors, especially public sector ones, which don't deliver. PSU defense stocks, PSU banks, sugar companies. I'm talking a bit generic here. These companies don't deliver the results. For example, defense companies like HAL have tons of orders. How they are not able to deliver the helicopters, the upgrades to engines? There are, yes, dependencies globally also. For example, GE is not supplying the engines. Reasons are fine, but end result is still same. Most of you will not want to deal with PSU banks as your general day-to-day bank account. Why? Sugar stocks, I have always spoken about just 2-3 stocks in my videos which deliver profits. They are companies which have been running in losses for 20 years. How are they surviving? What would the investors of those sugar companies do? One more category in this case is a lot of companies are doing capex via opex. which means they are using profit and cash flow to fund future expansion. EPS does not grow. It is very important to understand retail behavior. Just think about it. At 25,000 Nifty, everyone was saying buy, buy, buy. If Nifty goes to 20,000, there will be panic, chaos. Everyone will say sell and exit. Retail talks about safety, retail talks about risk, and they still invest in FNO. They hate large caps because the stocks typically are a little expensive, 3,000, 4,000, 5,000, or the general belief that large caps have already become large, how large they can become now. The standard philosophy I talk about many times, can't book losses. I will rather block my money for 2 years, 3 years. I'll sell when I break even. The love for quick money. Invest 10,000 with an expectation that that will become 15,000 in 1 day, 2 day, 1 month. And love for high percentages per trade, 20%, 30%. I can assure you, if you give a person an option to make 20% today or 2% every day for next 20 days, they will mostly choose this option. This is a bit special and not everyone is able to cite them. Golden trades. There will be one opportunity typically every 3 to 6 months to make good money. This is typically a trading opportunity, a swing trade, short-term trade, mid-term trade, but you can make immense amount of money in that. For example, last couple of months, we are seeing a run-up in investment banking related sector. Stocks like KFIN, CDSL, CAMS, they have gone up like anything. Consumption had a run-up in about Q2, but after that, consumption stocks have tanked. That is why I said these are trading opportunities, not investment opportunities. We saw a run-up in defense stocks. For example, there are shipping companies which are not even related to defense. They also went up like anything, and those investors now licking their wounds, sitting at 60-70% kind of losses. Now the market has cooled down, but we saw a run-up in crypto in December 24. We saw a PSU run-up in 2023. Everything that was PSU, that went up many times literally. So if you can cite these trends and these golden trades ahead of time, a lot of money can be made in terms of percentages. But remember, these are trades, they are not investments. You have to get out at approximately the right time. Otherwise, you will get caught. The final one is the best one perhaps for me. The cocktails taste better. There are a bunch of asset classes and many of them have correlations, positive or negative. For example, what I figured out is gold and silver have a negative correlation with crypto, typically Bitcoin. If Bitcoin is going up, gold, silver will stagnate or maybe go down. Then you have SIPs which work best in the long term, not in the short or medium term, especially if markets correct a bit. Mutual funds are there, ETFs are there. Specifically, all of these asset classes have different tax rates also. Then you have bonds. Right now, most of the bonds have become a little less popular because of the meltdown in microfinance companies and small finance companies. People are a little cautious right now, but bonds give better yields in fixed income. Equity, small, medium, large size companies, swing trades, FD, but with the OD combination. And I have videos for that on the channel. Real estate, which is again long term, especially if you hold it for 8-10 years, where your rental yield becomes reasonably good. So a cocktail portfolio of all these asset classes where you shuffle money around, that is important. A lot of people don't move money around at all. If FD rates are low and you have a lot of money in FDs, then it will not lead to good results at all. If gold has already run up, then maybe it will consolidate for some time. It is hard to predict these moves, of course, but that is the art. So as you prepare for 2025, the first thing which is important is to set sail, to be in the water. By staying out of the water, you won't be able to accomplish anything. Experiment, learn, and don't try to always stay in calm waters. Rough waters is where the money is made. Good luck and thanks for watching.